Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, we have much to discuss today. When I originally set out to make this video, I thought I had in mind what I wanted to talk about, but recent news events threw a wrench into all that, and I had to take a step back, replan, and create a new video. I hope that by the end of this, it makes some sense. I don't actually know if it will or not, but I'm hoping that it does. And what we will discuss today is largely the brewing currency crisis around the world that has been growing in intensity throughout the year, and it appears in the last week or two has started to reach a boiling point. So we will talk about the FOMC last week and the reaction to it because we haven't done that yet. But then we also need to talk about some of the moves of recent central banks and how it's affecting the market. I'll try to paint a cohesive picture. I will not be able to cover every event that has happened, in part because these videos have been spaced out and a lot is going on in between them. So to save you from listening to me for a full hour, I have cut it down to what I think are the most important points, and the rest we'll cover later. If you enjoy my content, make sure to give this video a thumbs up and subscribe to my channel. Thank you so much for all of the support, guys. You really help keep me going. Now we have a lot to discuss, so let's dive right in. Whew. Well, friends, we've got many things to talk about, so I'm just going to hit record, start going, and hope that it makes sense at the end. But where we will start today is with the FOMC. So last week on Wednesday, the Federal Reserve raised its interest rate 75 basis points, which is what we anticipated on this channel. It's what the market expected, and everyone got what they were looking for. But then we moved to what else came out of the FOMC. We had an interesting press conference, which we'll talk about here in a minute, but also we got an updated SEP. That's the Summary of Economic Projections. It is a model that shows where the Fed thinks different economic indicators will be over the next couple years, assuming their policy plays out according to plan, based on information today. So this is the SEP. I've drawn some lines on here. The bottom half of the screen is the new one. The one at the top of the screen is from December, right? From right at the turn of the year. There's a few things about this we'll talk about. The first one, if you note the change in various indicators, I think is showing a type of capitulation in the Fed. So we're seeing a change in real GDP growth. They thought we would see robust real GDP growth in 2022 of 4%, next year 2.2, 2024 2%. All of those are well over their longer run expectation of 1.8, and that's stout growth. 4% real GDP is strong growth. However, you move forward to now, 2022, they only think it will be 0.2 instead of 4%. Now we know the first couple quarters were already negative growth. We've experienced that. When you go look at the GDP Now model from the Atlanta Fed, it is saying that real GDP for Q3 is about 0.2%, 0.3%. So maybe we will eke out a positive growth in the third quarter, but the fourth quarter is looking abysmal from this vantage point, and we may get 3 quarters of negative growth in this year. Alas, real GDP growth has capitulated strongly, and then over the next 3 years, they don't expect real GDP growth to reach their longer run goals. So they're showing you growth is going to struggle for the next 3 years if the Fed has their way. The next thing we're going to talk about here, unemployment. So going back to the beginning of the year, they thought this year, next year, and 2024, unemployment would stay at 3.5%, which is an all-time low, if I'm not mistaken. We did hit 3.5. I think right now we're about 3.7, 3.6. We've been hovering around there for a few months. It's been stubborn. But if you go down here and you look at unemployment over the next 3 years, the Fed thinks it will jump to 4.4%. Now, this violates a very important rule in economics. Those of you who've been following my channel for a while know about this. We've explored this. But I recently found out that our investigations uncovered what is already a known rule in economics. It's known as the SOM rule, and it states that if unemployment jumps more than 0.5% in a given year, it doesn't happen without a recession. Behold this chart. Faithful watchers of Alpha Beta Soup are familiar with this chart. Premium subscribers to my newsletter got an interactive version of this chart in the latest issue. What this chart shows is the unemployment rate over time, and at the bottom are blue and red lines anytime the unemployment rate has jumped more than 0.5% in a 6-month or 12-month time frame. Now, what you'll notice is that everywhere you see these colored lines, you see gray bars indicating indicating a recession. Now, some of you may be familiar with this spiel, but I will say it one more time. Unemployment goes down slowly over long periods of time, and when it rises very quickly and uncontrollably, and in almost every instance of it reversing and going higher, it goes much higher than 0.5%. This is a look at unemployment just in the window of time that we have considered official recessions. And if you look back at the chart, you can see unemployment doesn't rise only in the neat little window of time that we consider the recession. It can continue rising after that. It can start rising before that. But just to make my point, this is looking at only those windows of time that are official recessions, where employment was at the beginning and where it was at the end. And if you go back to 1948, every single time that it has happened, it has risen at least 1.1%. Not 0.5, but double that. So at the bare minimum, based on history right here, and again, this is a conservative estimate, we're looking at an unemployment rate that is most likely to be somewhere closer to 4.7 or 4.8% or possibly higher. And that is a best case scenario. So when we see the Fed calling for 4.4 after they said 3.5 9 months ago, and they have really fully capitulated on real GDP growth, yet somehow inflation has barely moved at all, they're capitulating on the soft landing. They're basically saying tacitly, without openly admitting it, that we will probably not see a soft landing. We will probably induce a recession, and when that happens, unemployment will rise uncontrollably. That is what history shows us. It shows us that with remarkable consistency, and we can see that every time unemployment has risen, even just in the window of time that we consider the official recession, it rises much more than what the Fed thinks it's going to. So that is a concern that I have with their upcoming projections. I think that they are softening up the public to accept that a recession is probably going to happen. So now let's move to the press conference. This is Rachel Siegel of the Washington Post. She asks a question about unemployment. Let's hear what she says, and then we'll look at Powell's answer.
The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
So Powell gives a really long answer, and he tries not to be super obvious about what he says. He kind of hems and haws. He talks about various factors making the labor market tough to read. But then at the end, he says the part that I think is the most important. So let's hear that piece.
The chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
So Powell says that the chances of a soft landing are likely to diminish so long as policy needs to be made restrictive, and particularly if policy needs to stay restrictive for longer, if rates need to stay higher for longer. Well, friends, that's literally what they're showing us here. Growth will be restrained for years. Rates will be maintained at a higher place for years. If the Fed gets what they want, right? If the market is able to digest and tolerate these things and not utterly collapse upon itself and force them to change, which I do believe it will at some point. In the meantime, however, they are telling you, by not telling you obviously, what they intend to do, and that is to continue squeezing this economy. Because unemployment is only at 3.7%. We have $30 trillion in public debt, and we need to get interest rates up and keep them up for a while to help melt away some of that debt and to help return some amount of normalcy to the markets. I don't believe that they will be able to reach their long-run goals. Their balance sheet is not likely to be reduced significantly, but until they admit those things, we're all along for the ride here. Now, one thing I did find interesting is that the person who just asked that question about unemployment is also the person who asked another question about unemployment in June at the first 75 basis point hike, and we talked about this on the channel.
The higher unemployment rate necessary in order to combat inflation, and what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
To which Powell said in response,
a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome.
an unemployment rate rising to 4.1% or higher, while inflation is on its way back down, they would see that as a successful outcome. We talked about this on the channel back in June. I think the market ignored that little piece in the press conference, and what do you know, Rachel Siegel following it up with another strong question from the last FOMC. So we've got the Fed raising rates, talking about higher for longer. They think that the unemployment rate is going to jump to a place where history says we're probably going to have a recession. That takes the soft landing completely off the table if it was still there to begin with. But does that mean that we must go straight into the ground? Well, no, it doesn't. We do see equities really clinging to the support here, while Bitcoin kind of drags along the same levels. And Bitcoin was already here. It had already pulled back to its June lows and has just been hanging out here. And I think it's watching Legacy. Legacy had much further to move down. It moves more slowly. And now it has come down to the June lows that Bitcoin was already at, which to me throws some water on the decoupling narrative that invariably always emerges from Bitcoin Twitter whenever Bitcoin doesn't move in the exact same way as equities. Well, it's because BTC was already here and equities had to come all the way back down to this level. But now we're here and all the markets are hanging out. The real question that we have to ask ourselves, is the Dow Jones correct? Is it telling us the future, or is it going to be dead wrong? And at this juncture, it's hard for me to say. Now, if we go look at the S&P, we could look at the Dow, but we'll just look at the S&P. What if we knock out some little quick and dirty TA here and try to identify, like, is it possible? Could we see an argument that we could make our way higher from here? That we don't have to just go into the ground, even though we hear that we're going to have higher interest rates, higher for longer, more central bank tightening, etc., etc. Well, sure, we could. We did that in June and August, but there's a difference, right? We got this rally here. Could we do that again? Maybe. However, what we got back here was a couple of different catalysts that really helped price action. The first one was cooling off of gasoline prices. So if we go look at gasoline futures, that's RB1 on TradingView, the top for gasoline prices was in June. The middle of June, everything started to cool off. Well, if you go back here and you look, where did the market turn around? The same time that energy prices started to cool off after this catastrophic fall as a result of a big CPI print. So we start seeing energy prices cooling off and the market thinks, wow, maybe inflation is going to get better, and they start rallying. And then we get up into here, and somewhere right in this moment, we got an FOMC that the market interpreted bullishly. We talked about this on the channel here. We did not think this was bullish. However, the market thought, okay, the Fed is data dependent. They say we're at neutral. Let's go to the fucking moon. So we rallied even more. What is going to be the catalyst for that now? We're all the way down here. We see what's going on. Obviously, I can see a little bit of a green candle. Does that mean that we're going to reverse? This rally played out over like a 5-week period where we had significant catalysts. We had energy deflation. We had bullish Fed. Those really helped to push us. We do not have those things over here yet at this moment. In fact, we're getting more bearish catalysts. So we had the Fed raise rates. We're talking about higher for longer. And then you hop over here and you look at other currencies and they're in their own world of problems. Let's look at the pound sterling. This is one that has had a painful few days. Last week, the Truss administration unveiled its new budget and it was not received well by the markets. They involved some tax cuts. They lifted the bonus cap on bankers, all in an effort to try to stimulate economic activity by releasing pressure on the upper class. It's classic trickle-down economics. That shit doesn't work, and the market rejected it. The pound sold off hard. Here, if I show you the pound the other way around, you can see the fall, right? Let me put my sigma indicator on here. This measures standard deviations, which is a move outside the normal average. And you can see here on this day, this is the day the budget was revealed, that we had a 6.5 sigma move on the British pound. That is an enormous, gargantuan move, particularly for FX markets. And if you zoom out here, the last time that there was a move of even remotely comparable size was back here in the middle of March of 2020, and it still wasn't as big of a move. So we're seeing an historic move in the British pound. And in fact, if you do this same exercise and you put it on the DXY, it shows you that we are in a currency crisis. Look, this is my measure of standard deviations going all the way back. This is July 2020, the last 2 years. All these gray bars, look, I'm even going to turn these off. These are low sigma events, regular average events. Well, if I zoom out here and you guys look at this. Look at the relative quiet that we experienced over the last couple of years since COVID. This is COVID right here. And then look, basically since May, we've seen an explosion of multi-sigma events in world currencies happening right before our eyes. This is volatility in the world currency market as it relates to the US dollar. And the dollar has been the number one and basically only beneficiary of this volatility. So then what happens this morning? The Bank of England intervened in its own market. They stepped in, warning of a material risk to UK financial stability, and they decided to start buying long-dated treasuries. This is essentially a form of soft QE. But the weird thing is that the Bank of England is still trying to raise interest rates. So the world is about to find out what it looks like when a central bank, a heavily indebted central bank, is raising interest rates while running quantitative easing. We have not seen that before. And now it should be painfully obvious to everyone observing this saga that this situation is wholly and completely fucked. There is no good way out of this scenario for the UK, for Europe, for the United States. We are all connected at the hip. You're seeing serious instability happening in the UK markets, and they're getting gun shy. They're getting nervous. The Bank of England still intends to raise rates, but they're also intervening as a buyer in their treasury market. Mixed signals out of the Bank of England. This comes on the back of Japan just a week ago announcing that they intervened to prop up the yen for the first time since the 20th century. They sold some dollars to buy some yen because their currency is also weakening. If we go look at the yen on a big chart, it's currently sitting at 1998 resistance levels. And this is the place where the Bank of Japan has decided to try to defend its currency, right around 145 USD JPY. Will that level break? I don't really know, but this is happening at the same time that we are seeing what's going on with the pound sterling that we were just exploring. And it's having an historic rout, now down to 1985 levels on the British pound. Mixed messaging is coming out of the US as well. It's not just other central banks. So we already reviewed the Fed's own projections for the economy. They think real GDP growth will come down significantly. Unemployment's going to jump. We'll probably have a hard landing and an ugly recession. And they're saying higher for longer. You see the Fed, Evans, this is the Chicago Fed president, 4.5% unemployment would be a very good outcome. It's not going to stop at 4.5%. Fed's Bullard, the credibility of the Fed's inflation targeting regime is at risk. Also Bullard, markets are underpricing higher for longer rates. These are all from the last couple of weeks, and what they're trying to tell you is that they think the market is underweighting the likelihood that we will have tighter conditions for longer. And they're saying we're just going to keep tightening the screws. Then you have the Treasury Secretary, Janet Yellen. Yesterday, she said, "We haven't seen liquidity problems develop in markets. We're not seeing, to the best of my knowledge, the kind of deleveraging that could signify financial stability risk." She says markets are functioning well, not disorderly. But then you pull up something like the MOVE Index. That's MOVE on TradingView. It's the bond market volatility index. And what do you see? Year-to-date highs on bond market volatility threatening the COVID highs. And when you zoom out even more, the COVID high is the only thing keeping us from being at great financial crisis levels on bond market volatility. US Treasuries underpin countless other markets. So the stability of that organism needs to be maintained at all costs. And based on the reactions that we've seen from the Bank of Japan and the Bank of England in the wake of their own disorderly markets, maybe we're seeing a hint at what the Fed will be having to do in the near future. But we aren't there yet. So we're getting mixed messages from the Bank of England, mixed messages from the Bank of Japan, mixed messages from the United States, mixed messages from the ECB, which we didn't even mention in today's video. And I believe that we are in the early innings of an historic sovereign debt crisis that has not even begun to truly unfold. Just in the last week, we started to see the wheels maybe coming off in the UK. But even that could take some time to play out. I know that it can be tempting when we're in these environments comments to think that any move to the upside is a surprise and suddenly a reversal of fortunes. But it's important to remember that market liquidity is thin across the board, both in equities, in crypto, in the bond markets, and thinness goes both ways. So when there's not a lot of order friction, the price can move in either direction with very minimal effort. And things happen non-linearly. So when we get a pump for a few days, but the overall conditions have not changed in any meaningful way, it's important to marry those concepts in your mind as an investor and to understand that the price in the short term can lie to you, but over the long term, it will tell the tale. And amidst all of this, we look at equities hovering above their June lows, wondering what the fate of the market will be. Each asking themselves, does the Dow Jones know something that we don't? Is the Dow telling the future, or is it wrong? Will we manage to find support here and manifest upside inexplicably in the face of what looks like a sovereign debt crisis? Is Bitcoin going to decouple and become a safe haven asset, even though it's a less than $500 billion market cap and most people still treat it as a risk asset? These are questions that I see being asked on Twitter. I don't know the answers to any of them, but my suspicion is that we will be looking back at this moment a year from now from a much lower place in the markets. Now, I don't say that lightly. I'm not excited to come on here and present a very bearish case to you, but I'm not a very good liar, and it's hard for me to make content that I don't believe in. When I look around at the rate of change of interest rates, at the amount of indebtedness around the world, and then I see the strength of the dollar for which the majority of global trade and debt management relies, I see significant problems for the global economy over the next year. I see a global recession coming, one that could be significantly worse than anyone's models are projecting. But those things don't occur in a vacuum, and the response function of the Federal Reserve and other central banks will change that calculus. It will affect that trajectory, and we will be here to observe it, to digest it, and to talk about it as it unfolds in real time. What a time to be alive. This is an historic period for the generations alive today. This is the kind of global event that only happens about once a lifetime for the average person, and we may be on the precipice of experiencing ours. So, if you may be wondering why we don't look at Bitcoin more closely, why I'm not really showing on-chain, why we're not talking about the derivatives market and people speculating on price over there, it's because I don't think that any of those are very important right now. They may be interesting, we may be able to glean some kind of minor insights from them, but they're not driving the bus. Sovereign debt, the bond market sell-off, the health of the economy, what's going to happen to people's unemployment, the inflation rate, all of those are what is driving the markets and the narratives. So it's important that we keep our finger firmly on the pulse. Make sure you follow me right here on Twitter at TXMC Trades. This is where all my thoughts and analysis go in the moment before I package them up into the videos and into my newsletter, which I launched about a month ago now. This is where I post some of my longer form ideas. I give interactive versions of the charts you see on my channel and on my Twitter page, and it's a way for me to try to turn this into a living. So I appreciate you checking out my newsletter. It's my pinned tweet on Twitter, and there's a link in the description to this video down below. But whether you choose to support me or not, we will continue watching these markets together, trying to project forward what we believe will happen based on historical data and talking about it together so that we can keep ourselves sane. And that is where I will leave it today, friends. This was a very hard video to make. I feel like I've been saying that a lot lately, that my videos are tough to make, and I hope that you see why. There's so much to talk about. There's so many different things that are changing, and trying to marry them together in a way that you can walk away with a little bit of understanding is an extreme challenge. I'm learning as I'm doing this with you, but through a commitment to the data, to objectivity, and maintaining historical perspective, those will help us to be successful. So I'm glad you're here with me. I appreciate all of your support, and I hope that this video made some sense. But you guys can let me know in the comments if there's anything I missed. We didn't talk about the housing market. I didn't really dive into CPI as much as I thought maybe I would. There's just too many different things to touch on. We'll save some of that for next time. If you enjoyed this content, make sure to give this video a thumbs up and subscribe to my channel. And with that, I will let you go. Until we chat again, take care of yourselves, friends. Be kind to each other. Maintain a healthy savings of cash. Try to watch less mainstream media, and you and I will chat in the very near future. Cheers, everyone.